$6 trillion vanished in less than 60 minutes. Not lost, not evaporated, transferred from your account into someone else's. While you were making coffee, while you were checking your phone, while you were convinced the rally would never end, the largest coordinated wealth extraction in precious metals history just executed. I am Ken Au. Welcome to the Vault. Today, we expose the mechanical theft behind the crash. And by the end, you'll know the exact signal that tells you when. If you bought gold at $5,600 or silver at $121, you're staring at red. Your portfolio just took a beating that feels personal. It feels like the market singled you out, targeted you specifically, made you the example. You're wondering if this is the top, if the bull run just died, if you should cut your losses and walk away before it gets worse. Stop. Breathe. Because what you just witnessed wasn't market forces. It wasn't natural price discovery. It wasn't a correction. It was engineered, deliberate, surgical. Let me show you the crime scene. Gold dropped from $5,600 to $5,100 in the time it takes to watch a sitcom episode. That's $500 gone. A 9% collapse in 60 minutes. Silver fell from $121 to $180. That's $13 off the price. An 11% wipeout. Do the math. If you had $100,000 in silver at the peak, $11,000 disappeared while you blinked. That money didn't burn. It didn't cease to exist. It moved. It flowed from retail accounts into institutional coffers like water finding the lowest point. The mechanism is called a liquidation cascade. It sounds complex. It isn't. Think of dominoes arranged in a line. Each domino represents a trader who borrowed money to buy metals. Leverage traders, margin traders, people who bet with money they don't actually have. When the price drops even slightly, their broker makes a call, a margin call. Put up more cash or we sell your position. Most people don't have extra cash sitting around, so the broker sells. That selling pushes the price down further. That triggers the next margin call, the next forced sale, the next domino. But here's what makes this truly devastating. These margin calls happen automatically. There's no human on the other end asking if you want to hold. There's no negotiation. The computer sees your account below the minimum threshold and executes the sell order instantly at whatever price the market will take. And when hundreds of these automatic sells hit the market at the same moment, the price doesn't decline gradually, it gaps, it jumps down. Your stop loss that you set at $5,400 to protect yourself, the price blew right past it. You got filled at $5,250. Your protection failed because the market moved too fast for the order to execute at your desired level. This is the trap within the trap. Retail traders think they're protected with stop losses. They think they have a safety net. But in a true liquidation cascade, stop losses become accelerants. They add fuel to the fire. Every stop loss that triggers is another sell order hitting the market. More supply, less demand, price drops faster. Selling triggers, selling. Price drops trigger, more price drops. It becomes a waterfall, a stampede, a self-feeding mechanism that doesn't stop until everyone leveraged is wiped out. This is where things stop making sense for most people, because crashes this specific don't happen randomly. They don't occur because investors suddenly decided gold isn't valuable anymore. The metal didn't change. The utility didn't vanish. The industrial demand didn't crater overnight. Only the price tag changed. And the price tag changed because someone wanted it to change. Institutions don't react to crashes. They create them. They see retail investors piling into a rally, getting confident, using leverage, setting stop losses at predictable levels, and then they pull the trigger. They dump massive positions to kick off the cascade. They know exactly where the dominoes are lined up. They know exactly how much selling pressure will trigger panic. And then they sit back and watch retail investors liquidate themselves, watch them panic sell at the bottom, watch them hand over their positions at discounted prices. It's not a conspiracy, it's a business model. The mainstream news will tell you this was volatility, normal market noise, healthy correction. They're reading from a script. Crashes this fast and this violent are never accidents. They're hunting expeditions. But here's what most investors missed. This wasn't about gold or silver fundamentals suddenly changing. This was about the dollar, specifically about the DXY. If you don't know what the DXY is, you're trading blind. The DXY is the dollar index. It measures the strength of the US dollar against a basket of other major currencies: euro, yen, pound, Swiss franc, Canadian dollar. When the DXY goes up, the dollar gets stronger. When it goes down, the dollar weakens. Here's the only rule you need to understand. Gold and the dollar are enemies. They sit on opposite ends of a seesaw. When the dollar rises, gold falls. When the dollar falls, gold rises. This isn't a theory. It's mechanical. It's gravity. Think of it this way. Gold is priced in dollars globally. If you're in Europe and you want to buy gold, you first have to convert your euros into dollars. Then you buy the gold. If the dollar suddenly gets 5% stronger against the euro, you need 5% more euros to get the same amount of dollars to buy the same ounce of gold. Gold didn't change. but it became 5% more expensive for you. Now multiply that across every country, every currency, every buyer globally. When the dollar spikes, gold becomes simultaneously more expensive for everyone on Earth who doesn't use dollars. Demand drops. Price falls. This is the hidden mechanism that controls the entire precious metals market, and most retail investors never even look at it. They're watching gold charts, drawing trend lines, looking for patterns. Meanwhile, the dollar is the puppet master pulling all the strings. Gold didn't crash today. The dollar spiked, and when the dollar spiked, it created a gravitational pull that dragged gold and silver down with it. Look at what happened. The DXY jumped, not gradually, suddenly. A sharp spike that caught most traders off guard. And because gold is priced in dollars, that spike made every ounce of gold appear less valuable in dollar terms. Professional traders understand this. They don't watch the gold chart, they watch the dollar. Because the dollar is the leading indicator. It tells you what gold is about to do before gold does it. So today, when the DXY spiked, the smart money saw it immediately. They sold their gold positions before the cascade started. They got out at the top. 5 minutes later, retail investors saw the red candles and panicked. They sold at the bottom. They became the exit liquidity. This is the hidden layer nobody talks about. The crash wasn't about metals, it was about currency. And currency moves aren't random. They're driven by 3 specific forces that all converged on the same day. Force number 1, the Federal Reserve. The Fed controls interest rates. And right now, the Fed is sending what traders call hawkish signals. That means they want to keep rates high. They're worried about inflation coming back. They're staying aggressive. When U.S. interest rates are high, investors around the world look at their own rates and get jealous. Japanese bonds pay almost nothing. European bonds pay barely anything. But U.S. treasuries, they pay real yield, enough to make holding dollars attractive. So global capital flows into dollars. Demand for dollars increases, the DXY rises, and when the DXY rises, gold gets crushed. Simple cause and effect. The market thought the Fed would cut rates this year. They thought the free money was coming back. The Fed just signaled they're not. Rates are staying higher for longer. That makes the dollar king. And it makes gold a peasant. But there's a deeper implication here. High interest rates don't just make the dollar attractive. They make borrowing expensive. And gold doesn't generate yield. It just sits there. So when rates are high, the opportunity cost of holding gold increases. You're giving up the interest you could earn by holding bonds instead. Institutions run this calculation constantly. Is the potential upside in gold worth giving up the guaranteed yield in bonds? When the Fed keeps rates high, that equation tilts against gold. The math says sell gold, buy bonds, and that's exactly what happened today. Force number 2, China, specifically Chinese manufacturing data. And if you own silver, this is where you need to pay very close attention. Silver isn't just money, it's an industrial metal. Over 50% of all silver mined globally goes into industry. Solar panels, electronics, electric vehicles. Every iPhone has silver in it. Every solar panel needs silver to conduct electricity. Every EV uses more silver than a gas car. China is the factory of the world. When China's factories are running at full capacity, they consume massive amounts of silver. Demand is high. Price goes up. But when China's economy slows down, when factories go quiet, silver demand falls off a cliff. We just got bad manufacturing data out of China. Factory activity is contracting. Production is slowing. That means less demand for silver as an industrial input. Traders saw that data and immediately started selling. They didn't wait to see if it was temporary. They sold first and asked questions later. Let me break down the numbers. China consumes roughly 30% of global silver production for industrial use. That's thousands of tons annually. Their solar panel industry alone uses more silver than the entire jewelry sector globally. When that consumption drops even 10%, it creates a supply glut. Too much silver, not enough buyers. Price collapses. This is why silver dropped 11% while gold only dropped 9%. Silver got hit harder because it has industrial exposure. Gold is pure money. Silver is money and a machine part. When the machine breaks, silver bleeds more. And here's the terrifying part for silver holders. China's slowdown isn't temporary. Their economy is dealing with structural problems. Real estate crisis, demographic decline, debt overhang. These aren't issues that get fixed in a quarter. They persist for years, which means industrial silver demand could stay suppressed far longer than anyone expects. Force number 3, political uncertainty. The U.S. government is facing a potential shutdown. Congress can't agree on a spending bill. The deadline is approaching. And markets hate uncertainty. Now, government shutdowns are usually theater. Politicians yell at each other, the media freaks out, and then they sign a deal at the last second. But markets don't care about what usually happens. They care about what could happen. And uncertainty creates fear. Fear creates selling. The shutdown risk wasn't the main driver, but it was the excuse, the trigger, the snowflake that started the avalanche. Because traders were already nervous. Gold had just rallied 30%. Silver had surged 65%. People were sitting on huge profits. They were looking for a reason to take money off the table. The shutdown gave them that reason. They sold, and their selling triggered more selling. The cascade began. Three forces: Fed hawkishness, China slowdown, political chaos. One of these alone might cause a 2% dip. All three hitting at once? That's how you vaporize $6 trillion in an hour. But here's what doesn't make sense. None of these forces are new. The Fed has been hawkish for months. China's slowdown has been ongoing for quarters. Political dysfunction in Washington is permanent. So why did the crash happen today? Why this specific hour? Because someone wanted it to. Someone with enough capital to move markets decided this was the moment to pull the trigger, to dump positions, to kick off the cascade, to hunt stop losses and liquidate over-leveraged positions. This is the system failure nobody wants to acknowledge. Markets aren't neutral. They're not fair. They're not balanced playing fields where everyone has equal information and equal opportunity. Markets are hunting grounds, and retail investors are the prey. Think about who benefits from this crash. Not you. Not the person who bought gold at $5,600 thinking they were getting in on a breakout. You got crushed. Your portfolio is down double digits. Your confidence is shattered. But the institutions, the banks, the hedge funds, they're fine. In fact, they're better than fine. They just bought your positions at a 10% discount. They sold high. They crashed the price. And now they're buying back low. That's the game. That's always been the game. The question you should be asking isn't, why did gold crash? The question is, who profited from the crash? Follow the money. When $6 trillion changes hands in 60 minutes, someone is on the receiving end of that transfer. Someone just got a lot richer. And it wasn't the panic sellers. Now here's the part that should terrify you. This isn't the first time this pattern has happened. In fact, we saw this exact setup just weeks ago. Late December 2025, the last 2 days of the year. Sharp, violent crash out of nowhere. Panic selling. Liquidation cascade. Everyone screaming that the bull run was over. And then January started. And the market didn't die. It exploded. Gold rallied 30%. Silver surged 65%. The biggest monthly gain in decades. Everyone who panic sold in December missed the entire move. Look at the calendar. We're 2 days from the end of January. Same timing, same pattern, same fear. The setup is identical, which raises an uncomfortable question. Is this crash the death of the rally, or is it the setup for the next leg up? History suggests the latter. Because this is how bull markets work. They don't go straight up. They climb, they correct, they shake out weak hands, and then they resume. The corrections are brutal. They feel like the end, but they're not. They're intermissions. Go back and look at every major bull market in history. 1970s gold rally, 2000s commodity boom, 2010s crypto explosion. Every single one had multiple 20% to 40% corrections that felt like the end of the world. And every single time, the market recovered and went higher. The people who sold during those corrections got annihilated. They locked in losses. They missed the recovery. They watched from the sidelines as the bull market continued without them. The only people who made life-changing wealth were the ones who held through the pain. The fundamentals didn't change today. While you were panicking, Tether was still buying gold, 1 to 2 tons every week, like clockwork. Did they stop because of a 60-minute drop? No. They don't care about volatility. They're accumulating. While you were staring at red candles, central banks were still stacking. China, Russia, India, Turkey, Poland. They treat crashes like sales, like Black Friday for gold. They didn't sell today. They bought because they're not trading. They're positioning for a currency crisis. The de-dollarization trend didn't reverse. Countries aren't suddenly running back to the dollar because gold dropped 9%. The long-term trajectory is still away from dollar dependence. That hasn't changed. The silver shortage didn't magically get fixed. 5 consecutive years of supply deficits, mines running dry, industrial demand growing. That structural problem didn't disappear in 60 minutes. So what actually changed? One thing: sentiment, feelings, emotions. Weak hands got scared and sold. Strong hands stayed calm and bought. That's it. That's the only difference between someone who survives this market and someone who gets wiped out. But sentiment can flip instantly. It flipped negative today. It can flip positive tomorrow. And when it does, the people who sold at the bottom will watch in horror as prices surge past where they exited. This is the escalation loop you need to understand. Fear creates selling. Selling creates lower prices. Lower prices create more fear. The loop feeds on itself until everyone who was going to sell has already sold. And then, with no sellers left, the price reverses. Hard, fast, without warning. That reversal is coming. The only question is timing. Is it next week, next month? I can't give you an exact date. Nobody can, but I can tell you what to watch for. 4 specific signals that will tell you when the bottom is in. Signal 1, the DXY. If the dollar index peaks and starts rolling over, gold will bounce immediately. They're inversely correlated. When one tops, the other bottoms. Watch the dollar, not gold. The dollar is the leading indicator. You're looking for the DXY to hit a resistance level and fail. You're looking for it to make a lower high. That's your signal that dollar strength is exhausted, that buyers are done pushing it higher. And when the dollar stops rising, gold stops falling. It's that simple. Signal 2, volume. When the selling volume spikes to extreme levels and then suddenly drops off, that's capitulation. That's when the last seller throws in the towel. When volume goes quiet after a crash, the bottom is usually in. Look at the volume bars on the chart. Today's crash came with massive volume. Millions of ounces traded hands. But if tomorrow and the next day show declining volume, even as price stays low, that tells you something critical. There are no more sellers. Everyone who wanted out already got out. And when sellers are exhausted, buyers take control. Signal 3, China. If China announces stimulus, if they inject liquidity into their economy, if they restart factory production, silver will explode. Industrial demand drives silver price. China controls industrial demand. Watch China more closely than you watch silver. You're looking for policy announcements, interest rate cuts, infrastructure spending, anything that suggests China is prioritizing growth over stability. When China stimulates, factories roar back to life. And when factories need silver, price moves fast. Signal 4, Federal Reserve speakers. If Fed officials start sounding worried about the economy, if they hint at rate cuts, if they shift from hawkish to dovish, the dollar will weaken and gold will rally. Listen to what they say, not what the market wants to hear. What they actually say. These 4 signals are your compass. They'll tell you when the crash is over and when the rally is resuming. Until then, you're guessing. And guessing in this market will bankrupt you. But there's a deeper problem here, a problem that goes beyond this specific crash. This crash revealed something structural, something broken in the way markets operate. Leverage, excessive, reckless, insane leverage. Traders borrowing 10x, 20x, 50x their account size to bet on gold and silver. When the price moves 2%, they get liquidated, their accounts go to zero, and their forced selling drives the price down further, liquidating the next wave of leveraged traders. This is a design flaw, a systemic vulnerability. And institutions know about it. They exploit it. They know exactly where the liquidation levels are. They know how much selling pressure it takes to trigger a cascade. And they use that knowledge to hunt retail traders. Every single crash follows the same pattern. Price rises, retail gets confident, retail uses leverage, institutions dump, liquidations cascade. Retail gets wiped out, institutions buy back cheap. Repeat. If you're using leverage on gold or silver right now, you're not trading. You're gambling with the house edge stacked against you. The house being institutional traders with better data, better execution, and no emotional attachment to their positions. Cut the leverage. Kill it. If you can't survive a 20% drawdown without getting liquidated, you're positioned wrong. This market will swing 20% in a day. If that swing kills your account, you're not going to make it. Now let's talk about what you should actually do. Not what you should feel, not what you should hope for, what you should do right now with your portfolio. If you're holding physical gold and silver, do nothing. Physical metal is insurance. It's not a trading vehicle. You don't sell your homeowner's insurance because your house didn't burn down this year. You don't cash out your life insurance because you're still alive. Physical metal is protection. It sits in a vault or a safe, and it protects purchasing power over decades. The crash didn't change the long-term reasons you own physical metal. Currency debasement is still happening. Central banks are still printing. Debt is still growing. Geopolitical instability is still rising. None of that changed in 60 minutes, so your physical metal position shouldn't change either. You own physical metal to protect against systemic risk, against currency collapse, against government failure. Those risks are still present. In fact, they're increasing. Every $1 trillion of debt added makes the system more fragile. Every political crisis makes the endgame more certain. Physical metal is your protection against that endgame. Don't sell it because of short-term price movement. If you're trading with leverage, cut it immediately. Take the loss if you have to. But get out of the leverage trap before it kills you. This market is too volatile for margin. One bad day, and you're done. It's not worth it. The potential gains don't justify the risk of total account destruction. If you're sitting in cash, waiting for an entry point, this might be your moment. But don't buy all at once. Average in. Buy a position now. If it drops more, buy more. If it rallies, you already have exposure. Scale into the position over days or weeks, not hours. The best entries in bull markets happen when fear is maximum, when everyone is panicking, when the headlines are screaming about crashes and collapses. That's when smart money buys. Not because they're brave, because they understand that maximum fear usually marks minimum price. If you bought at the top at $500-600 gold or $121 silver, you have two choices: panic sell and lock in the loss forever. or hold and wait for the market to recover. History says bull markets recover from corrections, but history doesn't guarantee the future. Only you can decide if you have the stomach to hold through more volatility. Here's what I know. If you sell now, you're selling to institutions at a discount. You're giving them your position at exactly the price they wanted to pay. And when the market recovers, they'll be the ones making money while you watch from the sidelines, sick to your stomach. But if you hold, if you can survive the emotional pain, if you can ignore the red candles and trust the long-term thesis, you still have a chance. Bull markets reward patience. They punish panic. What I'm watching now is February 1st, the day after the government shutdown deadline. The first 48 hours of February will tell us everything. If the fear evaporates, if buyers come back, if we see a bounce, that confirms the December-January pattern is repeating. But if we break lower, if the selling continues, that means something structurally changed. I'm also watching $5,000 on gold. That's the line. If gold holds above $5,000, this is just a correction. If we break below and stay below, we might be in for more pain. Silver's line is $100. Above that, we're still in a bull market. Below that, the trend is breaking. These are the levels that matter, not your feelings, not the Twitter fear, the actual price levels that define trend changes. Watch those, ignore everything else. Here's the brutal truth most people don't want to hear. Markets exist to transfer wealth from the impatient to the patient, from the emotional to the rational, from the people who react to the people who plan. Today, $6 trillion transferred. Some people lost, other people gained. Which side were you on? If you panic sold, you handed your position to someone who was waiting for you to break, someone who understood the game better than you, someone who knew fear would make you sell at the worst possible moment. But if you held, if you stayed calm, if you recognize this as a temporary disruption in a longer-term trend, you still have your position. You still have a chance. The game isn't over. The market is a machine designed to extract money from people who don't understand how it works. Today was a masterclass in that extraction. Retail investors got liquidated, institutions got richer, and the wheel keeps turning. The question is simple. Are you going to keep being the person who gets liquidated, or are you going to learn how the machine works and position yourself on the other side of the trade? This crash happened. It's over. You can't change it. What you can control is your response. Will you panic and make it worse? Will you freeze, or will you adapt, learn, and prepare for the next move? Because there will be another crash and another rally. That's how markets work, always have been, always will be. Volatility isn't a bug, it's the engine. It's how wealth transfers from the weak to the strong. Next time, make sure you're on the receiving end. But if you want to know the exact moment when the reversal begins, when the bottom is in and the rally resumes, you need to stop watching price and start watching the signal that institutions use. The signal that tells them when fear has peaked and opportunity is maximum. Most traders miss it because they're staring at the wrong chart. They're watching gold when they should be watching something else entirely. The crash isn't the end. It's the setup for what comes next.